Good morning, everyone, and welcome. This is Joe Scarice, co-founder and co-host of the Creative Birth Strategy House here on Clubhouse and the Creative Birth Strategy podcast live with Mr. Yardall Perkins of Perkatech, providing education, networking, and strategy. Let's get rocking and rolling here in just a few minutes. We're going to invite some peeps in to our, obviously, our moderator status here. Got Bob Chezik showing up here. Oh, boy. Oh boy, bringing the heat. All right, let's see who else we got coming up here. We'll get rocking here in just a few minutes. Good morning, Bob. How are you?
Good morning, Joe. I'm doing well. How are you doing today?
Good. I think it's today's discussion will be pretty good. How is it up in northern New Jersey? I mean northern New Jersey, up in the Scranton Mountains.
It's very cold. It was -3 today.
We already know that you're in. We already got the insanity part out of the way, though, Bob. We know this stuff.
Yes, reasons.
I know. I get it. So why?
Just breathing the degrees of probably what a -1 is.
That's great. Well, another great week, as you know. I've been traveling a little bit. We'll get everybody updated here in just a few minutes. We do have a guest speaker, just waiting for her to come on. And I hope she does get on here. So we'll get her in a few minutes, but we'll get started here in just now. I want to give everybody a little update. I just was away for a full week in Austin, Texas. Flew back in Friday night, and it was a really excellent opportunity. I was approached about a month ago to run up the Northeast, pretty much the East Coast Northeast area of the United States for a hedge fund that just acquired a lending group. It's called Park Place Finance, and I'm an executive here. So I'll be running up the whole area, up the Northeast area. I mean, I'm licensed. I'll be licensed in almost 47 states. I'm like there's like 2 states that we don't lend in. But I'm very excited. I was there for a week, meeting all the people, the processing operations, the hedge fund people. Very excited about the whole thing, everything that's come together with it. The products, the programs, the white label, where we can obviously white label with individuals and they could broker our money. The referral partner program, which is, I feel, extremely strong, where we could pay referral partners or real estate professionals up to 1% without brokering, off the HUD, so they don't have to get worried about any type of concerns there. I'll be opening up that program quite a bit, but the white label brokering for capital partners is there. The referral partner is there, and then direct to investor is there. I've already signed up a property management company that has 16 locations throughout the country with a referral partner program, so that's already up and running. Sent out sizers to at least a dozen of my mortgage brokers. I got to get more out as I go, but very excited about this opportunity at Park Place Finance. I did update my LinkedIn, my Facebook. There is a newsletter going out tomorrow morning, 9 a.m. to 1,000 different newsletters throughout the country. So very excited about the whole, opportunity. A hedge fund called Ellington acquired Park Place. So this opportunity kind of really made a lot of sense. The pricing is somewhat one of the most competitive pricing in DSCR in the country. Their base rate starts at 5 points. The floor rate starts at 5.75 right now, and the construction financing is as low as 7.99. We can go up to almost 95% on purchase, 100% on construction, and 75% loan to value on after repair value. We have a new construction product for investors where you don't need new construction experience. And that's a whole different discussion, which we'll get into down the road. I have a whole booklet that I've put together for guidelines as well that I will be now going over at the workshops, the white label workshops for people. So the classes I've been having the last couple times, they've been growing, but they're developing into something. So I am now putting together a booklet for all the individuals that take the white label course, so they understand guidelines, or at least get an idea of what guidelines look like in the lending space. Because it'll be very important for them to understand parameters, not for just themselves, but for their clients if they're licensed real estate professionals. They need to understand the guidelines in the non-QM space to really take that industry to the next step. So I'm very excited to be able to announce that here on the podcast. We are going to stay here every Sunday morning, 9 a.m. Eastern Standard Time. We'll combine it with Clubhouse, and we're on 300 Facebook groups as we speak. We're trying to line up the LinkedIn piece as well to go live. We're on YouTube Live. Then Yordell and his team loads it up to Spotify and Buzzsprout and all those other great spots where we are. We're now hovering way over 150 episodes, 10,000 downloads. 2 years of podcasting on this podcast, on the website itself. So I'm very proud of all those milestones that we've hit. And with this new position as an executive director here at Park Place Finance, senior account executive, I'm very excited about this opportunity as well, because it's just going to fully circle what we're doing here as real estate professionals. So let's go into the economic update for the market. Then we'll get a couple articles, and then we're going to get into Desiree, and I have questions for her in our discussion today. STR versus MTR rentals, profit, risk, finance, and future of flex living. So let's get a quick update on our economic week. Before we talk strategy, deals, or opportunities, it's critical to ground ourselves in what the economic environment is signaling this week, because in 26, markets don't reward optimism. They reward preparation. This is not about headlines. It's about how capital, risk, and behavior being priced right now, and how disciplined investors and professionals adjust accordingly. Need to keep an eye out on interest rates in the capital markets. This week, the market continues to focus on interest rate stability, cost of capital normalization, not cheap, but more predictable. Rates are no longer the primary variable, structure is. Investors who underwrite them with margin and multiple exits will remain active. Professionals who can explain why a deal works, not just what the rate is, win trust. The market is rewarding certainty, liquidity, awareness, and clean execution. Inflation and employment and consumer signals, sticky service inflation, cooling but stable employment, consumers becoming more selective, not disappearing. Rent growth is more market specific, not universal. Expense discipline matters more than appreciation assumptions. Cash flow resilience beats aggressive leverage. Underwrite reality, not recovery timelines. Credit tightening versus credit availability. Asset-based and private capital remain active. We're very active. A lot of DSCR loans right now in my pipeline, probably close to 30 week one. DSCR, bridge, RTL, meaning fixed to rent, fixed to flip, is going to be very aggressive going into the next couple months. It's not frozen. Liquidity is available for qualified operators. Capital hasn't left the market. It has raised its standards, though. So like getting 95% on purchase and 100% construction, you've had to done 5 deals in the last 3 years. Qualified real estate inventory from qualified real estate investors. This separates those two. What does this mean for real estate professionals, the agents that are listening in, insurance agents, etc., title agents? Education now outweighs marketing. Execution now outweighs volume. Strategy now outweighs speed. Professionals who thrive understand deal math, speak investor language, anticipate friction before it shows up. This week's environment rewards clean files, realistic comps, conservative leverage, and clear exit strategies. How I would position myself going into this week, 2026 is not a wait and see markets. It's know what you're doing market. The investors and professionals who win are not louder. They are more disciplined and more prepared and more intentional. Today's goal is not to predict the market. It's to operate intelligently inside it. So That's my thoughts in opening the market today and going into the week. Rates closed out probably about 6.15 on the 30-year fixed. Commercially, we're somewhere around 6.5 on the 30-year money, 6.25, if you want to buy the rate down a little bit. But it's getting very aggressive in the DSCR space. Like I said, I already put 30 loans in 1 week on DSCR, maybe 2 to 3 fixed to rents, fixed to flips, but very aggressive on the DSCR space nationally. Nationally, people are very hyper focused in getting their cash structured and moving on to future deals. So, couple quick articles that caught my eye. Apartment rents dropped to the lowest level in 4 years. I have been seeing this in the Northeast. I've been talking about this for months, but it is very apparent rents are dropping. So, if you're looking at a market rent, I wouldn't go out of my way saying that I'm going to obtain that market rate in some of these markets. So definitely keep an eye on that. Single family rentals lose ground as renters seek affordability. So again, with a lot of these apartment buildings going up, there's a lot of competition between the small landlord and the big landlord. It's going to be very interesting going into Q2 what the rentals will look like. But I definitely see a compression. So my thoughts to our discussion today, and I look forward to this in the next minute. STR versus MTR rentals, profits, risk, finance, and the future of flex living. And my opening thoughts for Desiree, and then we'll get her to introduce herself. The rental market isn't splitting; it's diversifying. STRs and MTRs aren't enemies anymore; they're tools. And in 26, the winning operators aren't picking sides. They're building flexibility in the asset itself. STRs still offer a headline upside. MTRs, by contrast, are quietly becoming the adult in the room. The real shift is flex living. Properties designed, furnished, and financed to toggle between STR and MTR depending on season, regulation, and capital markets. Investors who understand both models and structure for optionality are reducing downside while keeping upside intact. In this next discussion with Desiree, we're going to talk about, owning adaptable inventory, managing risk deliberately, and aligning financing with how people actually live and work now. Structure beats rate, flexibility beats hype, execution beats everything. Desiree, good morning and welcome. I appreciate the opportunity this morning. I know Linda from Real Day 411 put us together a couple of weeks ago. Please introduce yourself, who you are, what you do, and we'll get into some questions I've put together for our discussion this morning.
Fantastic. Good morning, everybody, and thank you so much for joining. Can you hear me okay?
Perfectly.
Perfect, great. Thank you. I'm Desiree Dubois, and I've been a realtor in the real estate industry since 1989. First as a realtor, then as a broker, and then for the last 20-something years as an investor. And what we do a lot of syndication, but we invest in and purchase properties for co-working, co-living. We started a company called Homework in 2018. And that was designed so people could live where they work where they live, anywhere in the world. But I've had experience in multi-residential nodes, STRs, triple net, and all different types of real estate. And right now, as Joe mentioned, you have to go with what the market is demanding. And the market is demanding it, not for many reasons, for financial reasons, for social reasons, just for being able to participate more lively in their life in the midterm and the short-term rentals. So that is why he led this conversation today.
Well, Desiree, I hear that you're from my area of the woods. A little background on yourself and like your bio, where you grew up, where you made your bones, and where you at now.
Okay, so I grew up in Philadelphia. I was born and raised there, and then I went to college at Miami, University of Miami. Then I went out to Southern California to USC, and I majored in marketing and business administration. So I've been an entrepreneur literally since I was 12 years old. So I've always been in business, in different types of businesses, from modeling schools to dance schools to marine and mermaid service to different types of things. But what has always when I became an adult, as you mentioned, I needed something that had more profitability and more longevity. And that's why I got involved in real estate. So I started with real estate as a salesperson, and then I, evolved over the years into different types of real estate. That's the beauty of real estate. You don't have to stay in one asset class the whole time. Be diversified, flow with what the market and what your callings are. I just recently moved to New Jersey. Beautiful Southern California. I moved from 80 degrees. Now we're at 8 degrees this morning. To be with my sons. I have two sons and a 1-year-old grandson. But since I'm renovating a house here, but going anywhere, you can do everywhere. Everywhere I go, I'm looking at.
So what part of Jersey you moving to?
I'm in Morris Plains.
Right. My goodness.
Right now, we're renting a condo in Orange.
Oh yeah.
We renovated, but we took it down to.
Okay.
But
If you need any suggested restaurants in that area, I'm very familiar with that area. I grew up in Kenilworth, New Jersey. Went to Rutgers Newark. Was a forensic auditor for the state of New Jersey my first 8 years out of college. So I know the area very well, and I know my food. So I'm actually going to be at the Newark Summit tomorrow.
My source.
I appreciate that. But I'll be at the Newark Summit tomorrow morning from 7:30 to 4. It's a big event on Broad Street with developers from the Newark, Jersey City, Elizabeth area. About 500 people will be there. It's pretty exciting. It's the point of entry to get in is very high. So I think the people that are going to be in there are going to be extremely engaged.
Wow.
Yeah.
Wow.
It's $400 to walk in the door.
I have to learn and find out what's going on here now that I'm in the East Coast. I don't know about any events, so I'm going to resort to you for that as well.
I appreciate that. Yeah, and the third Thursday of every month, we do hold an event in Newark, New Jersey, at the City Rub Smokehouse. Myself and Joseph Hernandez coordinate that event with Van Robinson, who is part of Jumpstart Newark. We're getting now about 40 to 50 people now at the event. I think it's going to grow even more so because I'm getting more involved in that northern New Jersey market just because of higher ticket level. But yeah, I think you're in a great location. Morris Plains is a beautiful area and convenient to just about everything. So thank you for coming here this morning. I got some questions for you in regards to STR, MTR, flex living. What's the profitability comparison that differs between, like in your thoughts, between short-term rentals, mid-term rentals in today's market, and what metrics should investors prioritize when modeling returns for each strategy? The differences between STR and MTR. Like, where's the profitability right now? Where do you see that?
Well, if you pencil it out, by the night rate. So say, for example, with easy math, you get minimum $150, $200 a night for the STRs, where you would maybe get a flat fee, 3,000 or 4,000, depending on property for the month. When you pencil it that way, it's much more profitable with the STRs. Because again, the same thing with the versus long-term rentals, you're getting it nightly. But people forget to factor in is your occupancy. Okay, so we do, of course, even at 60 to 70% occupancy, do not get high.
Into like expense and operating cost dynamics. What are the key operating cost differences between managing STR versus MTR and like turnover, utilities, furnishing, marketing, and how should they have been factored into your projections?
Well, STR costs are more. Then you start off with your housekeeping. Um, Housekeeping is very important. It's
Very concerned about demand and market factors right now. I feel like guest preferences shifted over the past 24 months, and economic and lifestyle trends are driving demand for, STR and MTR a little differently. What are you seeing?
I'm seeing that well, with a lot of the changes in the STR, like as far as let's use example Airbnb and so forth, there's so many fees now that are being implemented for both the guests and for the host, as well as the cost again of cleaning fees. I've seen some when I go to rent a place for maybe again a weekend, I see some cleaning fees that are almost as much as a day rental rate. That, just levy myself.
I identified a couple condos I'm looking at, I'm acquiring, that they're only allowing MTRs. They're not allowing any STR, which I'm okay with it. I get a little nervous with the Jersey and tenant eviction. If they decide not to leave, and on the MTR space, now you're kind of stuck with these people in some circumstances. So like I got to dive more into the leasing arrangements for the MTR, for me at least, to get more comfortable with it, because I'm not comfortable with it. I like a 1 year lease or get the hell out, you're done kind of mentality. So like the 3 month or the 6 month MTR is just a different structure. You know what I mean? especially like in the Northeast. You know what I mean? So that's just my thoughts. You're not all just in the Northeast, which is different.
Yeah. Like you mentioned, it's regulatory. We have no control over that.
Yeah.
So you could be again, and even within associations, and we're within different associations with cards of 31 days, whatever. They can change that at any time. They can just have a board meeting and change what they are going to require. So
Yeah.
it is. You really have to, and then especially when you talk about condos, they're so competitive. There's so many of them because that is the most popular. Those are the most popular rentals on the market are the condos, the 1 bedrooms, the 2 bedrooms, have situations. So you just have to be careful.
So let's dive into financing challenges and opportunities. I mean, Park Place Finance is very aggressive on the STR space, MTR space. Obviously, we just need to look at Air DNA and compare, make sure that numbers make sense and the appraisals is the backbone to the entire deal. Your appraiser is going to kill or make light to make it look really good. What challenges have you run into financing wise? And are you looking at opportunities with financing groups in regards to STR versus MTR assets?
We have done a couple of different ways. We definitely have some of them we've had, like you mentioned in Mexico, we had the new all cash. Mm-hmm. But some of the other ones we do these loans. We do like 20% down the conventional loans, the STR loans. We have found it really depends on the lender and the underwriter how much they have in their portfolio, how familiar they are with the STRs and MTRs. If you go to some of the conventional, banks, walk in, they don't have that comfort level. So they're going to require more down payment. They're going to underwrite it differently, more definitely as a commercial loan. As opposed to, we've gotten away with some properties as a residential loan. Yeah. Because the property itself is still residential and we just had a commercial use. So if you need someone like yourself that's one familiar with the loans and know how to underwrite them and know how to appraise them, because again, they, like you said, they have different resources for them to be able to use, like Airbnb.
Or before, I'm going to look really into what the numbers are if STR, MTR doesn't work out for you. I'm going to look at the market rent. And if that means you're going to have to bring a little more money to the table because of leverage, I'm going to require that versus if you've done one or two STR, MTRs and you have them in your current schedule REO that you own and they're working correctly. So I'm gonna weigh that out. If you've never done an STR before and you think it's going to be a great experience and you're only going to put 15% down, that's not going to happen if it's not doesn't have a trailing 12 on the property.
It's inconsistent.
Yeah, I mean, I think people that have delusional expectations. Hey, I'm going to buy this beautiful place down in, I don't know, I'm just using an area, Key West. And it's just going to hit the ground running. Yeah, but you're not from there. You're buying from somebody else. It's never been an STR, and you're now going to run one, and you don't even have any experience owning one. So it's just an interesting perspective. My thought and I'm going to pivot, and then we're going to open up to the moderators, Desiree. My thoughts to how does this tie into the future of flexible living? Looking ahead 5 to 10 years down the road, or now, or in the next 5 years, I can't look 10 years down the road. How does STR and MTR and the hybrid model, like corporate housing, it's evolving? Where do you see the macro trends and defining success in that space? Because I know we're touching on flex living as well.
Yes, and you're correct as far as people that are getting these properties and thinking they can start. Because even seasoned operators are having to constantly pivot, adjust, and to watch. So not even for the seasoned operators, so not everyone is a home run. So your thoughts are right on. Going forward, I do see the market going towards this way, not necessarily short term and midterm, but just people midterm. People wanting the flexible lifestyles. Even the new apartment buildings and complexes are offering different options now. They combine it with co-working and some other amenities to bring people more factors there, so people are not just there for long-term residential, but be there for a short. So a lot of apartment complexes or the new ones are offering that. A lot of hotels like to use some spaces into a longer bid. The idea that you can go and have to pay thousands of dollars and have a very small apartment. It's crazy. So people are looking for alternatives to that type of liability. So especially those who are traveling alone, or those who just
We're doing pad split lending up to 70% LTV on refinance and purchase, but they have to be able to they have to be working with pad split. If I can't get a P&L or a trailing 6 or trailing 12 from a pad split software, I'm not lending on it. You're not just doing a random rooming boarding house with me. You know what I mean?
yeah, and see that model has been working for a lot of people.
It has.
We had them look at one of our properties.
Yeah.
It's just we decided against it. But people just want a room. They want to be able to hang out with other people. They don't want to pay a lot of money in overhead.
I get it. Yeah, I get it. And we're going to now do a rapid fire with our moderators, Desiree. So they're very nice, and they're going to be very nice. They're going to be very nice. They're going to do we're going to do an introduction to, each one, who they are, what they do, and then they're going to provide either a statement or a question toward you in the discussion we just had for the last 30 minutes or so, 25 to 30 minutes. It just blew by. So we're going to start with ladies first. Of course, we have another rose amongst the thorns, who was the kind of young lady to invite you and make the introduction. Linda, good morning. Welcome. Brief overview who you are, what you do, and a statement or question for Desiree this morning on STR versus MTR Flex Living.
Morning, everyone. Good morning, Joseph, Desiree. What an enlightening talk this morning, very educational. Desiree, I wanted to ask you, I know that you're expanding homework. You have property out of the country, San Diego, Las Vegas. Tell us what's next for homework, and where do you see homework in, let's say, 5 years from now?
Thank you, and welcome, and thank you so much for this introduction. I so appreciate it. What we're looking at now, we're seasoning Las Vegas, but what I'm focusing on is the market. It's a property in Portugal that we're looking at. It's a boutique hotel, 14 bedrooms and so forth, and other places like that. But more importantly, we're going more towards the 50 plus audience. we realize that there's a lot of markets for, again, the younger people as far as co-working, co-living, and that's wonderful. And many places have both. They have all ages, which is also great. But there also is the desire and some different activities that comes with the co-working, co-living that someone that's older. And there's a lot of people that, again, are divorced, single, yet they're still working, they're still involved in their business, they're still traveling. They just don't want to go and sit in a hotel or Airbnb room alone. So they love to be able to go part of the community, do activities with other people. So we're going to kind of find some properties that really be personal. That may not be the ones that's in the center of the city, where all the action is, and maybe something that's maybe just
Vegas, even though I got married there, Desiree. And I've been there like 20 plus times myself for one function or another. I feel like that's being looked upon as a compressing market right now. And more people, that younger demographic is going toward Miami, going more toward Miami and some other casino-like settings because a lot of people are not drinking as much. So Vegas is not that attraction like it once was. So it'll be interesting how it shifts its dynamics to attract, that person that wants to vacation there. You know what I mean?
well, the market there is that we're thinking of the people more towards the people that are going to work. They're still building a lot of there.
Yeah.
I've heard, they're building a lot of infrastructure, a lot of corporations, a lot of companies, a lot of sports facilities. So we're looking for the people that have to go there for 6 months or a year to facilitate that, the admin back office type, and that need a place to stay. We're definitely we're not really marketing to the travelers. We're looking for people like that.
Yep.
And for teams that have to come out, they're building a shopping center, they're building something, they need to do the whole team, much more economical team in one house as opposed to paying for 6 or 7.
One of the markets that we're not really. I mean, we'll lend there, but we're gonna cut back on LTC and LTV and leverage, and leave some room for us. God forbid we got to take the property back. So just keeping that in mind because not that I want to be a Debbie Downer there on certain markets, but hey, Philadelphia right now is not a hot spot to lend in right now. They're cutting down back by 5 to 10% on leverage between construction and or long-term money DSCR. So same thing's happening in Baltimore, St. Louis, Chicago. This is not something that is an uncommon discussion. So I appreciate Linda's insight. Bob, good morning and welcome. Brief overview, who you are, what you do, and thoughts or statement or questions for Desiree in regards to STR, MTR, flex living, finance risk, etc.
Thanks, Joe. My name is Bob Chesick, president of Chesapeake Corporation. I do LLC setups and corporation setups. I'm not here to give legal or tax advice. Like,
He does all my referrals for registrations for LLCs for a lot of my clients.
Well, it's a good person to know.
Yeah, excellent. Bob, thank you as always. Yeah, I get a little nervous with a lot of the out of country stuff because, we don't lend there, and people are like, oh, why don't you lend? I'm like, there's enough business in 48 states. Like, how much more do you want me to do? You know what I mean? So that's the only thing I always get concerned about as a lender when somebody is doing these out of country opportunities. I get a little not skittish. I just get nervous for not just the individual doing it, but the investors that get involved with it. So I'm glad you were able to kind of explain that with Bob, how you structure that. We'll move on to Mr. Felix Buchanan. I've known Felix almost 20 years. Good morning. Welcome. Brief overview who you are, what you do, and thoughts to it, or statement or question for Desiree in regards to STR versus MTR flex living.
Good, thank you.
Some good news. Park Place Finance will lend in Baltimore as well as Houston.
Sure.
Absolutely. I mean, there'll be some concerns with, the client themselves, experience and location. But we are comfortable lending there for the time being, depending on where the location. Baltimore, it's definitely almost block to block for that matter. Yeah.
Absolutely. Is that okay, Joe?
Yeah, absolutely. If you could put it in the chat, I have all your information too. If anybody wants to email me directly, do not message me on this app. I barely look at the messages. I know somebody just below saying, "Hey, I messaged you on here." My phone number and my email is on my profile. If you can't call me or you can't email me, you have a whole nother set of issues. So, I'm very easy to get in touch with. Like Desiree, I called you this morning. It took a minute. Yeah, it's not complicated. Conversation's still available out there. And yes, Lawanda, I do lend. Oh no, somebody just asked me. Oh, Kim, I do lend in Washington and Arizona. Yes, I do on both. So yeah, Arizona's always been a little funky. Um, so Lawanda, you have my number. You could text me or email me. It's on my profile. Just throw me a text because I don't save the room chats and all that stuff. So that all disappears on my screen when I'm done with the pot with this discussion. So my phone number, I'll put it in there, 215 290, because I have Desiree's number in my phone now. So 215-290-5108 is my cell. So you could just easily text me, and it takes a quick text, and I will get back to you right away on whether it's an introduction to Desiree or any discussions on our lending, the white label courses, uh, all of it. Like Felix has taken our white label course. He was there, the first one in Philadelphia, 35 people. The next one we had 20 plus. We got one coming up in South Jersey. We're gonna have about 15 because it's a small room. Um, so we're in North Jersey, and then we're in Lehigh Valley, and then we're back in Philly, and then I'm also gonna be in Atlanta for a class teaching. So it's starting, expand, teaching people how to underwrite, understanding guidelines, being a good referral partner. I mean, listen, I am more than happy to wire you money if you close a deal with me. So that's the beauty about the non-QM space. We want to wire you money. We want to make everybody money in this space. Like, how do you not want to work with somebody that wants to make you money? That is the question of the day. And then when Linda was kind enough to put me in touch with Desiree, I was like, hey, Desiree, listen, it has to apply to what I'm doing to have this conversation, right, Desiree? I did
Yes,
my
absolutely.
it's got to make sense. And if it doesn't make sense, then it doesn't make sense for me to have somebody on the podcast to interview. So this has been great. I appreciate Bob and Felix so far. And one of my co-hosts to the Lehigh Valley uh, event that we have every month, second Wednesday. It's coming up this week with my CPA Joe Reyes. We're going to dive into CPA work discussion at Fegley's Bethlehem Brewworks. We got David Bergio. We're also going to host a cigar event coming up in the next couple of months. He's helping me scrub my database. He's become a great referral partner as well. Dave, good morning. Brief overview who you are, what you do, and your thoughts or questions for Desiree regarding STR, MTR versus flex space, flex living in the profit, risk, and finance.
Yeah, awesome, Joe. Thank you so much, Desiree. Pleasure to have you on today. Good morning, everybody.
way, there was a big announcement Friday into the weekend. Lilly is bringing in like thousands of new jobs, where I think that MTR, it's going to be crazy up there, and Lehigh Valley even more so because the inventory is so tight up there. It'll be very interesting how the valley expands and what they now will consider the valley. You know what I mean?
Yeah, well, yeah.
Yeah.
Eli Lilly.
Yep. Yeah, so it's going to be very interesting to watch how the valley how realtors will sell the expanded valley, not the valley itself, but we'll talk about that because I could pull data on who's actually really buying stuff in that market. For anybody listening in, I have a new data uh, accessibility where I could tell you exactly where people are buying, what LLC they bought in, who they did the lending with, what they bought it for, their phone number, email, the LLC name. Why I extend this to any of the real estate agents below, this is really good data to find out where people are buying and what they're buying at. So if you're prospecting markets, you could also prospect them for more deals to sell to. So whether you're looking for qualified true buyers or qualified true inventory, you need to work both. And I just put an article out about this as well. So it kind of ties into our conversation today because STR, MTR, and flex living is a whole nother dynamic to the investor and to the real estate professional for that matter. Stephen, good morning and welcome. Thank you for your patience. Brief overview who you are, what you do, and question or statement to Desiree regarding STR versus MTR and flex living.
Yeah, thanks. I'm Steve Franco with REI homepage on broker stuff. And actually, it's funny. I've been looking at the MTR and boxes for a little while.
Happening, I would either jump in, do your numbers, find out the contacts, how you can get those leads, how you can get those tenants, and keep it going. Make sure you don't.
see you in Lehigh Valley.
Yep,
Wednesday.
Each for coffee, 3:30. It's the other thing.
Absolutely. So, Desiree, I appreciate the discussion today. I think we definitely came from a different. We put this together rather quickly, and but I appreciate everything you've done on this conversation. Any final thoughts or statement for everybody listening in, and then I'll give my final thoughts, and then I'll talk about our events coming up, and then we'll wrap this up in the next couple of minutes. Felix, did you want to add something?
Yeah, I have a question. Have you thought about creating your own cleaning crews per each of those states? So that's one of the things.
Thank you, Felix. And final thoughts to our discussion this morning. Just, what was your vibe to our discussion this morning? And then I'll give my final thoughts, and then we'll discuss the events coming up that maybe you'll be able to get to meet in person.
Fantastic. Well, I'm looking forward to meeting everybody at some point in person. Feel free to reach out to me. I admire you and respect you and congratulate you on being on it. Getting up on a Sunday morning at 9 o'clock and tagging into something that could be change your life. I believe in real estate. Find it asset class that that
Thank you, Linda, for the introduction. And my final thoughts to this discussion, profits, risk, finance, and the future of flex living, along with STR versus MTR rentals in 26. Better or worse, there's definitely different businesses within these models inside the same asset class. So the investors who win in 26 will stop debating which model is superior and start asking one question: which strategy matches the deal, the regulation, and the operational bandwidth while protecting my downside? Profits are real, but only when they're repeatable. Risk is no longer hidden, it's priced and regulated. Finance is separating rental owners from rental operators. The future is flex living, but only disciplined models survive. With the winning investor mindset has a multi-exit low drama. You're not choosing a rental type, you're choosing a risk profile. Sustain the operation, protect cash flow under pressure, and pivot quickly if the market shifts. Bottom line, STR can produce bigger upside if the market is friendly and you run tight systems. MTR can produce cleaner stability if you choose real demand corridors and control costs. Flex living is the future. Discipline is the filter. And then I wanted to go over some events that we have coming up with a lot of our moderators. February 9th, tomorrow night, we're with Michael Diallo, attorney at law. Yordell Perkins and myself are hosting at TCS Property Management, Rooftop Deck, 2nd and Chestnut, Understanding the Probate Process, February 11th with co-host David Bergio. We're going to be at the Fegley's Bethlehem Brewworks. How real estate investors should prepare when working with their CPA 2026 with Joseph Reyes, CPA. February 14th, we have 3 podcasts. The first one will be live on YouTube and Facebook. It will not be on Clubhouse. That will be me discussing why ground up is becoming the new fix and flip or BRRRR strategy. The following discussion will be with Nancy O'Brien of Jumpstart Lehigh Valley. And then at 12 o'clock, we have Natalie Kuzma. I will butcher her name, but Natalie from Knoxon Law. We're going to be getting into a real estate discussion. 3 podcasts in a row, live on Facebook and YouTube. So if you're not following me on Facebook or following me on YouTube, I would highly recommend, if you're going to get onto those. February 19th, why property management is the new deal killer or deal maker in 26 at City Rub Steak and Smokehouse in Newark, New Jersey. That's Thursday night, February 19th, 6:30. Then we're going to cap off the rest of the month at the Ultimate White Label Underwriting Asset-Based Lending Workshop in Collingswood, New Jersey at 900 Haddon Avenue, 9 a.m. to 3 p.m. We only got about 10 spots left. I'm not letting more than 20 people in the room. We dive into underwriting, dive into the guidelines, understanding non-QM, being a better real estate investor, being a better referral partner, or becoming a capital partner, mortgage broker with Park Place Finance and myself. Very excited about that. And then March, we're going to be having another class in North Jersey. April, we're up with David Bergio again up in Lehigh Valley. Then we're going to bring it back to Philadelphia in April. No, I'm going to say in May. But in April, I think I just got invited to have this presentation in Atlanta. I think it's the last Saturday in Atlanta with a real estate investing group. So we're really expanding our discussions. And of course, we're here every Sunday morning, 9 a.m. Eastern Standard Time, providing education, networking, and strategy. We're putting really good subject matter together. We are not like in any other clubhouse room. We are really going into very specific areas. If you'd like to also have a one-on-one podcast, we are offering that complimentary. Yordell and myself, we'll put it together. Whether you're not going to fly into Philadelphia, we could do it on Zoom and then coordinate that as well. But I always prefer the in-person discussion on Saturday mornings for those one-on-ones. My quote this morning: never say you can't do it. You just haven't done it yet. That one word changes everything. Yet term limits into timelines. So it keeps you in motion instead of stuck in the judgment. The moment you stop labeling something as impossible, your brain starts looking for the process, the reps, the structure. That's how real progress happens. Not talent, training. Not luck, preparation. Not motivation, discipline. Not I can't, I build toward it. Keep stacking the work. Keep showing up. You're not behind, you're in process. Have a great Sunday morning. Have a great week. Reach out to me directly. I'd love to give people some leads this week. And it would allow me to really bring some opportunities into your market. So if you need some leads, some buyer leads, some investor leads, let's have that discussion, how that would work working with me directly. This is Joe Scarice, co-founder and co-host of the Creative BRRRR Strategies House here on Clubhouse and the podcast with our other co-founder, Mr. Yordell Perkins of Perkatech, providing all your social media needs as a real estate professional or real estate investor. I want to thank everybody again, and I will be ending the room in the next 30 seconds. Thank you.
Great final thought.